Well, our two main stories dominating the business news today, so we've brought it up a little bit in the running order. Camille Knight is joining me here on set. Camille, talks between the US and Iran ending without a deal. Instead, President Donald Trump announcing he's going to blockade those ports. What's been the impact so far?
Well, as you can imagine, it's sent oil prices right back up, with tanker traffic at a halt again ahead of that 10 a.m. Eastern Time blockade. US crude oil jumped nearly 8% to $104 per barrel, and the international benchmark Brent jumped more than 7% to $102 per barrel. It's not quite at levels it reached after Trump threatened to wipe out Iran's civilization, but the price had plunged last Wednesday after Washington and Tehran agreed to a conditional 2-week ceasefire. If you look at the past 3 months, it's clear prices have been particularly high since late February compared to normal levels, hovering around that $100 mark. They're unlikely to come down before the Strait of Hormuz is permanently reopened and a ceasefire endures. Asia has been disproportionately affected due to its heavy reliance on Middle Eastern countries for oil and gas. Markets trading lower this Monday, the Hang Seng and Kospi trading down at around 1%. European stocks too starting the week lower as investors digest the breakdown of negotiations over the weekend. The DAX down nearly 1.5%. France's CAC 40 also down. Certainly investors will be looking at developments of the blockade later today.
So talk us through then why Donald Trump wants to blockade the Strait of Hormuz that he's been calling, of course, to reopen.
Well, that's because until now it's not been entirely closed. Iran, you'll remember, has struck deals with a few countries like India and Malaysia, allowing some tankers through in exchange for a toll of up to $2 million per ship. Those paying Iran a toll now won't be allowed through. But more importantly, Iran has been exporting its own oil through the strait, about 90% of it going to China. It's managed to sell about 1.85 million barrels of crude a day through the month of March, which is 100,000 barrels more than in the previous 3 months. Now, what that looks like in revenue is about $159 million a day. So it's a crucial part of Iran's military funding. And of course, because it's all Iranian ports that Trump is saying will be blocked, that means all other imports will be impacted as well. Exports will be impacted as well, including petrochemicals and non-oil products too. The reason Trump hasn't done this already is that blocking the strait to any oil, even Iranian, causes the price of oil to surge like we're seeing now again. The Trump administration had been trying to keep the price down, even granting a temporary license for Iran to sell oil that had been sitting on tankers, effectively dropping sanctions for a month. So the US adopting a drastically different approach there, possibly trying to strengthen its negotiating position, but of course at a cost for the global economy.
Well, another big top story of the day, of course, as we brought you to the top, is the election of Peter Magyar in Hungary. Of course, vital for business too.
Hungarians looking to a new future with Viktor Orban unseated after 16 years as Prime Minister. One of the key issues for voters was Hungary's stagnating economy, with inflation running high and growth at a near standstill. Now, Hungarians are hoping Peter Magyar can usher in reforms aiming at curbing corruption and unlocking billions of euros in EU funding. Brian Quinn takes a closer look.
A new day for Hungary as voters, fed up with corruption, authoritarian backsliding, and a moribund economy, finally ousted Viktor Orban.
Better economy and better life level.
Under Orban, Hungary's industrial policy focused on attracting foreign-owned factories for goods like German cars and Chinese EV batteries. But softening demand revealed the strategy's weakness. Hungary's economy grew by an anemic 0.3% last year. GDP is expected to rise by 2.2% this year. That bump, though, is largely tied to pre-election handouts from the Orban government aimed at securing his re-election, including raises for public sector workers and bonuses for police and military personnel. That spending will linger on the new government's balance sheet. Hungary's deficit is projected to hit 5.2% this year, with its government bonds one step away from junk status. Another side effect of such policies, Hungary has seen the highest cumulative inflation in the EU. Prices there up 57% on average since 2020, nearly double the bloc's overall rate. Meanwhile, endemic corruption and Orban's capture of formerly independent state institutions and the media had resulted in the blockage of some 18 billion euros in EU funds.
fact that the Hungarian government, due to its corruption, couldn't access the recovery funds is the prime reason why we didn't see an uptake after the pandemic in the economy.
Armed with a parliamentary supermajority, new incoming Prime Minister Peter Magyar is hoping a sweeping anti-corruption drive will quickly unlock some of those EU funds, helping to reduce debt and kickstart growth.
We'll, of course, be keeping up to speed with all those developments there.
Thanks very much, Camille Knight, with the business news this morning.